Hey, this is Brant from Wolf on Wall Street Trade with a market update for the week ending July 5th, 2019. This is a daily chart of the S&P 500. I'm going to zoom in to this area the last week on a 5-minute chart of SPY. And I have a few notes here. So last weekend we ended going into the G20 with a lot of uncertainty. Bonds were ready to go. Gold was ready to go. Stocks were ready to go. The result of the G20 was basically the two sides are going to start talking again, the US and China, over trade talks, but it was pretty vague other than that. So the market opened up big on Monday morning and then just sold off the rest of the day. There was a little buy program here about 3 p.m. Tuesday morning, the market came down again. There was a very, very defensive stance, like something geopolitical was going on. But the thing that really stood out was the extent of the volatility smashing Tuesday, just from the morning all through the day. Now, volatility, of course, is going to drop, and there were a lot of hedges built up going into the G20, so there was some relative strength in volatility. So all that pretty much happened Monday morning. VIX just dropped like a rock. You can see that here, and that's normal. That was just to be expected for the way the market opened up. But here on Tuesday and into Wednesday, the volatility smashing was unreal. And my opinion was that, President Trump was going to have the 4th of July in Washington, D.C., and it seemed to me that they really want to make sure the market closed green after this bad open on Monday. And then wouldn't you know it, Wednesday, half a day, right? Very low volume on Wednesday. Market made a new high right here. President Trump at like 10:30 a.m. that morning, tweeted out, record new high in the S&P 500. So everything made sense. It was an easy day to push the market around and a lot of volatility smashing to help that. And then the big event to me was this payrolls report on Friday. So you can see the market came down about 10:30, 10:45, another buy program hit, and it closed just short of unchanged. So the payrolls event doesn't look like a big deal, but as soon as the payrolls came out before the open, stocks sold off, bonds sold off, gold sold off, the dollar, the US dollar spiked. The point is, if you look at this June rally in the S&P, so this is pretty much all discounting about 50 basis points of rate cuts at the July meeting. While stocks didn't do a lot over here on Friday, they just came down in the morning. Everything else that has been tracking this, 50 basis point rate cut expectation totally retraced all of the moves from the FOMC. For example, here's a 15-minute chart of the US dollar, or UUP, and here's the reaction on payroll. So it retraced all of that FOMC 50 basis point discounting. Yields, Treasury yields did the same thing. I'll pull up the 10-year here. So here's the FOMC. Here's the decline and pricing in lower rates. And then here's Friday's payrolls. So they pretty much retraced everything post-FOMC. Also, yield curves had steepened since the FOMC. They flattened on Friday and retraced the entire thing. The only thing that did not retrace were stocks. So I actually opened up a little short position in SPY on Friday. So the point of me entering that trade, this is a daily chart of the S&P by the way, was that pretty much everything else retraced a lot of this enthusiasm, at least to the FOMC, of a 50 basis point rate cut. Stocks did not. So in my opinion, I think there's a really good chance they will, and especially because the S&P just poked above this level where we have a record new high, hasn't really established itself yet, and kind of all the reason, or a big part of the reason for this rally in June was just stripped away with the Friday payrolls report, making it less likely there'll be a 50 basis point cut. The S&P did make a new record high on Wednesday, half a day, just before the 4th of July holiday, and that is right here. Rather than going into all these different charts, I'm just going to show you a headline from CNBC on Wednesday. I just couldn't summarize this any better, how ironic it is. So I'll let you read it for yourself. I just want you to focus on this last sentence. So the S&P made a record new high on Wednesday, not led by growth sectors like technology or industrials or consumer discretionary or any of those, not led by FANGs, Facebook, Amazon, Apple, Netflix, Google. It was led by the most defensive and rate sensitive S&P sectors there are, real estate and utilities. Now, they not only outperformed, but they did about twice as good as the broader S&P. So they actually led the market to that new high. These are defensive sectors where people go when they're afraid the market might not do well. Since there is so much talk about whether the Fed is going to cut rates in July and whether they're going to do it 25 basis points or 50 basis points, I just want to give you a perspective on what the market has looked like in the past. Okay, so I'm going to start with the 2000 kind of cycle, and I'm using QQQ because it stands out more than the S&P. And this is really this bull market up to the 2000 high. And after that, things fell apart and we entered a bear market and a U.S. recession. So I'm going to show you actually what happened in here along the way with the Fed and what they did with rates. So first, let me back up this chart. I'm just trying to give you some idea of where we are, and I may zoom in a little bit actually. Okay, so here we are at the March 2000 high for NASDAQ QQQ, as it was technology stocks in the tech sector that led that bull market. Now I'm going to put on the notes. These are a little sloppy, but it's the best I can do on short notice. Okay, so we talk a lot about yield curve inversions, the bond market saying we think there's something wrong ahead. So here you can see the yield curve started to invert in early 2000. And this was the Fed's last rate hike, which was 50 basis points in May of 2000. And we're just going to walk forward, zoom in a little bit. So here's what the NASDAQ did since then. Okay, there was the new record high. Now, I always talk about, curve inversions are the warning, but it's curve steepening that you really have to watch out for after the yield curve has inverted. So here's a quick view of the 10-year yield curve minus the 2-year. And here you can see the dates, 1998, 99, 2000. There's curve inversion. Okay, this is recession in gray. This is sharp curve steepening here. So the yield curve will invert before the bond market is saying we see some problems with the economy down the road, and the steepening usually comes on Fed rate cuts, and it precedes a recession. Now, you won't know you're in a recession until afterward. They're always identified in hindsight and then revised. So getting back to our chart of QQQ, there's the record high. There's the last rate hike for the Fed's cycle, and here's where curve steepening actually started. And let's see what happens from there. Market starts going down, right? I'm going to zoom out a little bit so you get some perspective. And now I have these Fed rate cuts. Here's the first one over here at 50 basis points. As soon as that happens, the yield curve really starts to steepen fast. You can see the little note right here. So it started steepening here as the market's going down, then steepened really fast as the Fed made their first half point or 50 basis point rate cut of that cycle. And we'll go forward some more. You see the market comes down more. The Fed cuts rates again, another 50 basis points. Market comes down again, another 50 basis points, another 50 basis points. And this is the same month. And there's another 50 basis points the next month. 25 basis points here in June. And another 25, another 50, August, September. So you can see what I'm saying. Once the Fed starts cutting rates, it's actually not really a good sign. The economy actually went into recession just about 3 months after the first rate cut. And here you can see in 2001, the economy enters recession and the Fed's cutting rates all the way down. Over here, the recession ends and the market is still going down. The Fed is still cutting interest rates. And basically, we kind of bottom out here in 2003. So just take a look back. Yield curve starts inverting up here. Last Fed rate hike, pause. So this is kind of what happened early this year in January, a pause from a rate hike cycle, which ended in December of 2018. And the yield curve started steepening and then really started steepening when the Fed started cutting interest rates, and they did that all the way down. So now we're going to look at the 2007-2008, the financial crisis. Just so you can orient yourself, this is the S&P 500. 2003, coming out of that last recession. Here's the low. Here's the new bull market coming up to the all-time record high in May for the S&P 500 of 2007, and then one more in October. So we'll roll forward a little bit, and then we start entering the financial crisis. For those of you that remember, I mentioned back in late 2018 how similar this price pattern was to October through December of 2018, and very similar, but The big difference was that we were somewhere completely different in the cycle. And what we're going to do is back up here to about 2006 when it all started. So there's the bull market. Here we are in 2006, back up. 2006 bull market, early in the year, yield curve started to invert here in 2006. We'll walk forward a little bit. Here is the Federal Reserve's last rate hike. So this would be like kind of in our context, December of 2018, their last rate hike. And then remember, the Fed went to a neutral stance or paused very early in January. Here is that pause, and curves inverted again. So here's that pause. So this is kind of like early January 2019 this year, going from a rate hike cycle to a pause and yield curves inverting. We go into 2007. The market is making a new high here as the Fed went from a rate hike cycle to pausing, just like early January 2019 and the rally we've seen from there. So it goes up to a new high in 2007. You'll see it here coming up in May. Okay, there it is. And now it makes another new high. So a couple things. That was October. It makes another new high in October 2007. So here in June, you start to see the yield curves go from inverted, like we have right now, to curve steepening sharply. Why? The market is expecting the Federal Reserve to start to cut interest rates. Now I'm going to zoom in just a little bit closer because a lot of things happen here. So here we are moving up to that October new high. This was a big sell-off, and what did the Fed do? They put a bottom under that sell-off by cutting the discount rate, not the Fed funds rate, but the discount rate, and the market recovered, made a new record high. You see another cut. Here's the new high in October. That is the ultimate high, okay? And the Fed makes 25 basis point cut to the Fed funds rate. Now, what happened here? The market turned lower. So watch what happens. And we come into this area. This is the area I've covered quite extensively. Another Fed funds rate cut here, 25 basis points. And here's what it looks like if you kind of just zoom out. The bull market, the high, the new record high, 25 basis point cut. We'll zoom back in a little bit. And here in 2008, sell off sharply, right? What did the Fed do? This is pretty spectacular. Right here, you can't really see it that well. They did a intermeeting 75 basis point cut. Nobody knew about it. It came before the January meeting, and then at the January meeting, just a week and a half or so later, they cut rates again by 50 basis points. So this was kind of the genesis of this counter trend rally that I've covered in the past after this kind of same breakdown that we saw in October and then December. It's almost exactly like early January 2019, where Powell makes that very dovish pivot to neutral from hiking rates. The Fed is cutting rates again. We get a pretty decent rally here. Another 75 basis point cut, another 25 basis point cut. A lot of rate cuts here, right? And this rally rolls over. And there's the collapse of Lehman Brothers. This is the financial crisis. Remember, all these markets are very, very different, what caused things, but I'm just trying to show you what actual rate hiking and rate cutting cycles look like. So rate cuts, as you can see, do not portend good things in the future, at least the last two cycles. And the market continues to sell off. The Fed cuts rates again, 50 basis points, 50 basis points. The market comes down again, cut it 75 to 100 basis points here. At this point, we'll look back a little bit. At this point, that's the financial crisis. And right now, the Fed funds rate just went down to zero. And it stayed there at zero for just about 7 years. The market eventually does bottom right about there. You see here the recession started just after they started cutting rates. You can't make a direct connection and say, well, if they cut rates in July, a recession is going to be 3 months later. I'm just saying rate cuts don't portend good things for the economy and, by extension, the stock market. The last month, we've been seeing the stock market rally on the hopes of one of these 25 basis point cut or a 50 basis point cut. Another thing to be aware of is how different this cycle is than any others in the past. This is the Fed funds rate. You can see the years here, 1955 to where we are now. And we've had about 4 decades of the Fed funds rate just going down, down, down. Here's the financial crisis. From about 550 basis points here down to 0. There's the recession in gray. The average rate cut cycle from both this one here in 2000, 2001, and the great financial crisis is about 550 basis points. How much does the Fed have now? Half of that. So they don't really have enough room to cut rates to get out of a garden variety recession. So President Trump wants them to cut rates. But if the Fed does that, if they cut rates by 25 or 50 basis points, that's even less room they have to maneuver when they have to deal with a real recession and they need to be cutting 50 or 75 basis points at a time. They can only do that a handful of times before they're spent. So you'll hear a lot of talk now about the fact that people think the Fed funds rate will go not only to 0, but negative. So if it went on the same trajectory on average as the last 2 cycles, you'd have about a negative 3% Fed funds rate. Not just 0, you'd be into negative rates. You'd use Eurodollar futures as one way to play that kind of rate cut cycle and maybe going into negative rates. We know that they had to do QE here. It wasn't even enough, the 550 basis points. They hit 0, ran out of room, and started having to buy trillions of dollars in assets, in large part to bring down longer term interest rates, 10-year plus. So if you know that and you think that's going to happen this time, they're going to run out of room and have to do QE again and put trillions of dollars into the market that was basically printed out of nowhere, and you want to be on the receiving end of those dollars, we know historically that they have had to buy a lot of 10-year plus treasuries. And if they're going to go to negative rates, they're going to pay a premium for those treasuries. But the catch is, it's the people who own them now who will be selling to the Fed that will be making that money. The point is, there's a lot of different ways to play it, and you just have to understand that the cycle does look like it's changing, and that means totally different things for totally different assets and whole new opportunities. I'm still looking at this broadening top in the S&P. Let me zoom out a little bit. Here it is on a weekly chart. So this is 2018, started 2018 to now, and you can see it's still in effect. So as far as like position trades, yes, I do want to get short the market up near this upper trend line. So we'll take a closer look at that. We're not there yet. Here's a little closer view. And remember, it is an upward sloping trend line. So the more time it takes to get there, the higher that level will be. But right now, it's right in around this 30-20 to 30-30 area for the S&P 500. When do I not like it and think maybe the broadening top formation is bunk and no longer valid? Well, if we get 3% or more above this trend line, where I enter it, whether it's the S&P or something else, I don't know, but we're pretty close to it right now. So I'm going to leave it off there. I hope you enjoyed it. More than anything, just look at the rates, look at the yield curves, look at history, and get an idea for yourself what we're looking at, and then think about where the money is going to be going. There's a lot of different opportunities, but you kind of have to shift your focus and understand where we are in that cycle, what's happening, and what is likely to happen, and where you can profit from that. Have a great weekend, everybody.